Good morning, and welcome to TOI Japan Market Radio for Thursday, February 13, 2026. I'm your host coming to you from Tokyo, and this is your daily briefing designed specifically for global investors tracking Japanese markets. Today we're navigating some interesting cross-currents as global sentiment shifts, and we have our portfolio manager joining us to break down what it all means for Japan exposure.
Thanks for having me. So looking at the broader landscape today, we're seeing some notable pressure across Japanese markets, really reflecting the global risk-off tone that's taken hold. Market data is still coming in, but the key story is less about the specific numbers and more about the sentiment shift we're witnessing across equities, currency, and fixed income. What's particularly relevant for our audience is that Japan sits at the intersection of several themes driving markets right now, from technology sector volatility to interest rate expectations and safe haven flows.
Let's dive into the headlines then, because there's quite a bit to unpack. The dominant story hitting wires today is this broad-based sell-off that's swept through global markets, and it's being framed around fears in the artificial intelligence sector. We saw Friday the 13th bringing what some are calling a global sell-off in both stocks and gold as AI fear grips markets. Can you walk us through what actually happened here?
Absolutely. So what we witnessed was a pretty coordinated move lower across Asian equities on February 13th, and it's really driven by two intersecting concerns. First, there's this renewed skepticism about artificial intelligence sector valuations. Investors are clearly taking a step back and reassessing whether the rally in AI-related names has gotten ahead of fundamentals. Second, we're seeing fresh speculation around interest rate trajectories, both in the US and how that ripples through to Asia. When you combine those two factors, you get this broad-based risk-off sentiment that's prompting investors to reduce exposure across the region.
And why should investors with Japan exposure be particularly concerned about this combination of factors?
Japan is uniquely exposed on both fronts. On the AI and technology side, think about the composition of Japanese equity indices. You have significant exposure through companies like Sony, various suppliers to TSMC, and the robotics sector. These firms have been substantial beneficiaries of the AI boom, so any sentiment reversal in that space hits Japanese equities directly. On the rate side, remember that the Bank of Japan has only recently begun moving toward policy normalization after decades of ultra-loose policy. This means yen levels and JGB yields remain highly sensitive to shifts in global rate expectations. If US rate expectations move higher, that can accelerate yen appreciation, and that's a direct headwind for Japan's export-heavy economy.
So let's break down the impact across asset classes. Starting with equities, what should investors expect for the Nikkei 225 and TOPIX?
For Japanese equities, we're looking at downward pressure, particularly concentrated in the technology and semiconductor spaces. The broader indices like Nikkei and TOPIX will feel that drag given the weight of these sectors. Beyond tech, exporters are facing a potential double hit. Not only is there this global growth concern linked to AI fears, but if risk-off sentiment drives yen strength, that's an earnings headwind for companies that generate significant revenue overseas. The translation effect alone can materially impact reported earnings when the yen appreciates sharply.
Staying with the yen theme, what's your outlook on USD, JPY given this environment?
The yen is behaving exactly as you'd expect in a risk-off scenario. It's strengthening. When global investors get nervous and start pulling back from risk assets, the yen typically benefits from safe haven demand. Now, there's an interesting nuance here. If these AI fears translate into speculation that the Federal Reserve might cut rates sooner than previously expected, that would also be supportive for yen strength through narrowing rate differentials. Either way, the direction seems fairly clear in the near term, and that's something exporters and investors with currency hedges need to monitor closely.
And what about Japanese government bonds and the yield picture?
JGB yields are likely to decline, which means prices moving higher, as risk-off flows seek safety. Japanese government bonds remain one of the core safe haven assets globally, so when you see this kind of coordinated equity sell-off, fixed income typically benefits. The other consideration is that if global yields are coming down on growth concerns, that takes some pressure off the BOJ in terms of the pace of policy normalization. They'll be watching these dynamics closely because rapid yen appreciation can complicate their policy path.
There's another angle to this story that's worth highlighting. We're also seeing reports that Asian stocks slipped after this Wall Street tech sell-off, but interestingly, the headline notes that markets are still set for strong weekly gains. How do you reconcile that apparent contradiction?
That's a great observation, and it speaks to the importance of timeframe when interpreting market moves. Yes, we saw intraday weakness and a clear reaction to the US tech sell-off. That's the immediate pain point. But if you zoom out to the weekly view, Asian markets including Japan have actually built up substantial gains over the prior sessions. This suggests the underlying momentum remains constructive, possibly supported by factors like earlier yen weakness that benefited exporters or broader cyclical strength in the region. What this means practically is that we may be looking at profit-taking or a technical pullback within an intact uptrend, rather than the start of a major reversal.
So for investors, the key question becomes whether this is just noise or the beginning of something more significant.
Exactly right. The critical thing to monitor is whether this AI concern reflects temporary profit-taking after a strong run, or whether it signals a more fundamental reassessment of technology valuations globally. If it's the former, Japanese equities could find support relatively quickly, especially if the weekly uptrend reasserts itself. If it's the latter, if we're seeing a genuine repricing of growth expectations, then the implications for Japan's growth-sensitive sectors are more persistent and more concerning. That would warrant a more defensive posture, particularly in tech-heavy portions of the portfolio.
On the policy side, is there anything in particular you're watching from the Bank of Japan in response to this volatility?
The BOJ is in a delicate position right now. They've signaled a gradual normalization path, but that path is highly dependent on stable economic conditions and manageable currency moves. If this global volatility intensifies and we see rapid yen appreciation, that could prompt them to slow the pace of policy tightening or at least adopt more cautious forward guidance. I'd be listening carefully for any BOJ commentary on how global rate volatility and risk-off episodes might impact their domestic policy calculus. They don't want to tighten into a sharp growth slowdown or a disorderly currency move.
Shifting back to equities for a moment, you mentioned earlier the distinction between different types of Japanese stocks. Can you elaborate on which segments might be more vulnerable versus which might show resilience?
Sure. The most vulnerable segments right now are clearly the tech-heavy indices and growth names that have benefited most from the AI narrative. The Mothers Index, which is Japan's growth stock market, would likely see sharper declines than the broader TOPIX. Within the Nikkei and TOPIX, watch the semiconductor equipment makers, electronics companies, and robotics firms. Those are your direct AI plays. On the flip side, more defensive sectors like utilities, telecommunications, and domestic-focused consumer staples tend to hold up better in risk-off environments. Value-oriented indices and stocks with lower correlation to global tech trends should show relative resilience.
There's one more element we should touch on, which is the spillover into other asset classes like gold and commodities. The original headline mentioned gold also sold off, which is somewhat unusual in a risk-off environment.
That's a really important point and somewhat counterintuitive. Typically in risk-off scenarios, gold benefits as a safe haven asset. The fact that gold also declined in this episode suggests a few possibilities. One is that investors are raising cash across the board, selling whatever they can to reduce overall exposure, rather than rotating into traditional safe havens. Another possibility is positioning. If a lot of leveraged positions need to be unwound, even safe haven assets can get caught in the liquidation. For Japanese investors, this matters because it reinforces the yen's role as perhaps the premier safe haven in this particular scenario, outperforming even gold in that function.
So as we pull all these threads together, what's the tactical takeaway for global investors with Japan exposure right now?
I think the key is to differentiate between near-term volatility and medium-term trajectory. Near-term, we're clearly in a risk-off phase driven by AI valuation concerns and rate uncertainty. That means continued pressure on Japanese equities, particularly tech, and likely continued yen strength. Medium-term, the the picture depends heavily on whether this AI fear proves transitory or structural. Investors should be monitoring earnings revisions for AI-exposed names very closely, because that will tell you whether the market is right to be nervous. On the currency side, watch for any BOJ signals about tolerance for yen strength and willingness to adjust the policy path. And from a portfolio construction standpoint, this environment probably warrants some balance between growth and value, between exporters and domestic plays, rather than being heavily concentrated in any one theme.
That's really helpful perspective. Before we wrap up, any other signals or data points you're watching over the next few sessions?